Hi, everyone. I'm thrilled to be your moderator today for this exciting discussion about the evolution of cards, but especially in the context of scaling customer relationships. So I'm Julie Coburn, Director of Credit Card Strategy and Product Management at Equifax. And the latest data we've seen actually highlights how topical today's session is. So credit card debt is up at almost 6% year over year. We've got delinquent balances up 15% year over year. And the growth of these balances are predominantly due to sustained debt versus increased spend. And what we're seeing in the financial stress, it's acute within the younger demographic, where they're struggling with making payments. But interestingly, they're also looking for creative, flexible credit solutions. So our panel today features three diverse industry disruptors within the card ecosystem. We've got Alison Walsh, VP of Payments from People's Group, Richard Goyer, VP of Lending from Neo Financial, and Cato Pastole, co-founder and CEO of Loop. So welcome, guys. We're going to dive right in, okay? So let's tackle the issue of risk management in a data-scarce environment. So it takes significant time, right, for market challengers to build up their proprietary performance data. And this data deficit impacts your underwriting, risk, and customer engagement strategies. Yet you're finding success in targeting segments like credit builders and small businesses who typically have a higher perceived risk. So I've got a two-part question for you, yeah? How are you turning this data deficit into an agility advantage? And then how are you leveraging non-traditional credit data, AI tools, or underwriting innovation within the customer journeys to identify those that are likely to transition from a higher risk starter card through to a higher value lending relationship?
Great start. The lack of data is just an issue. We've only been in existence for 5 years. We only have about 1.5 million customers, so our ability to accumulate a big database of risk performance to build models from is just one of the facts of life that we have to live with. There are things we can do to address that. So obviously, we use machine learning for all our modeling, which, for a given set of data probably gives you a better model than you would otherwise get. And so it allows you to iterate more quickly. So we absolutely do a lot of that. We do look to source alternative forms of data. You may or may not have seen an announcement today that we're partnering with Prism on using their cash flow scoring, which is, again, a way of addressing the lack of data, both that we have, but also that a large part of our customer base has. So a large part of our customer base is either thin file or no hit. And so, picking up cash flow data from them is an important way of addressing that. The other thing, a couple of other things we do a certain amount of being prepared to invest to collect data. So, we will go into segments which we know are very high risk and that we may lose money on, but, it's worth spending that money to collect data. So we run those kind of experiments, well constrained, but as a way of collecting more data to build those models. And I think the other piece is using the machine learning to be able to determine outcomes more quickly. So rather than having to wait for a whole 12 months to understand the performance, there are machine learning techniques to derive predictive outcomes based on 90-day performance, which we employ as well to iterate. And I think the final thing to say in terms of how we deal with it is we recognize that at acquisition, we are struggling because we have minimal data about our clients. Our clients may be thin file or no hit. So the acquisition decision can be very difficult. However, as soon as we do start to collect performance data over those first few months on book, we leverage that very quickly to take action. So whether that is a CLI or a CLD, we do see that even 3 months data is enough to make a very significant separation in performance, and therefore we consciously exploit that to make early decisions on the book and iterate on them as fast as we can to compensate to the extent that we can for the fact that we are challenged acquisition because of the data issue.
Maybe I'll go next. So I think from the bank standpoint, touch on prepaid cards and prepaid programs specifically. I think this presents a very interesting data challenge in payments today. If you think about it from a bank perspective, we're dealing with multiple players. We've got program managers, the processors, the fintechs, and networks, and the card networks that we're all operating under kind of a complex regulatory umbrella that makes both kind of the risk management aspect more complex, and if it's done properly, makes it more powerful. At People's, kind of our approach has really been to treat prepaid cards as both the risk control mechanism and a strategic asset. So the transactional data that we receive gives us visibility into the spend patterns, load behavior, and velocity that can signal potential issues and potential misuse, particularly before it becomes a compliance issue. I think the other piece of data-driven underwriting that is for ecosystem growth is prepaid itself is not a credit card product. The transaction and behavioral data that is generated by these programs helps our clients understand those that are ready to graduate from such an offering over to an actual credit facility. That's how we move from kind of serving inclusion and into scaling kind of this offering more responsibly. And of course, this really only works if we've got a disciplined risk governance for our program. And I think a lot of people hate hearing risk and compliance, especially when you're dealing with fintechs who do want to be able to move faster. And this can sometimes be seen as a way of us trying to slow them down. But really strong onboarding due diligence upfront, understanding the PPM's business model, customer base, their funding flow, and operational controls means, and also translating that into the ongoing monitoring, means that we have better data, better sharing, better understanding of the underlying activity. So, from our perspective, prepaid is kind of the intro into getting some of that data and understanding kind of the future viability of a particular customer segment.
Do you want to add something about small business? Because that's lack of data there.
Yeah, absolutely. Yeah, to your point, small business credit is one of those areas where there's an immense lack of data. And taking a step back, that's also an area where we perceive us to have a competitive advantage, because if you look at the credit card landscape for small business cards, almost every small business card out in the market today is effectively a personal credit card that has a small business logo on it, right? So the underwriting adjudication model is effectively just built off of a personal adjudication model. And so that's an advantage where if you want to innovate and create more compelling products, oh, it got dark. Yeah. Create more compelling products for small business owners, we view the ability for us to look at other data sources as more compelling. So just to give you an example of that, we work with a lot of online merchants who sell on Shopify or Stripe or WooCommerce, et cetera, and we're able to leverage those alternative data sources in the adjudication of small business to have not just a more accurate view of what's happening in the business, but also a real-time view. And that's one of the big challenges in small business credit is a lot of volatility. So from 1 month or 1 quarter to the next quarter, you could see pretty big swings in performance and how a business is doing. And by integrating alternative data sources like that, we're able to create a product that actually allows businesses to get access to larger credit limits when the business is seasonal, like Q4, for example. If you have a lot to spend, you can increase limits. And then conversely, like earlier this year, when we saw tariffs and a decrease in demand, we were able to relatively quickly react to the market dynamics because we have that real-time data feed. So I'd say that's on the underwriting side, but it's also answering your question, Julie, on how do you see or identify patterns of when does somebody become a higher value customer. You can leverage the actual card data itself and the spend data, but you can also start to look at other characteristics of a business. So we have seen businesses in the life cycle of building the Loop credit card product of businesses that were originally spending $20,000-$30,000 a month to now spending $500,000 a month, right? And revenue of a couple million to now revenue of $20 million. Obviously, those are two very different types of companies, but that can be the same company just 2-3 years down the line, and then you can evolve your product to fit the needs of that larger stage business.
Yeah, totally agree. I think, having a look at the trended performance over time, whether it's a consumer or a small business, makes a lot of sense. I'm going to switch gears a little bit, and Alison, you started to mention this as well, but we're going to touch upon that essential balance between speed to market and compliance. So there's a natural tension, right, between innovation and the regulatory governance that helps instill customer confidence. We need this. But you're collective organizations, so you're often seen as agile and innovative. So how do you strategically manage this balancing act?
I think by not seeing compliance as a barrier or a reason not to innovate and not to innovate quickly, as a technology-based company, we operate at a natural pace of innovation and a velocity of delivery that is normal for a technology company rather than necessarily for a financial institution, and that the compliance element of things is simply one of the things that has to keep pace with that. Mm-hmm. I think it's in terms of what we're trying to deliver, it's about trying to deliver product and experience that meets the customer's needs, not the regulator's needs. So that's the focus of what you're trying to deliver. You have to do so in a compliant fashion, and therefore you have to follow the rules and do all of those pieces. But you don't have to view that as a break on things. It's simply part of what happens as you build these products and deliver to that velocity.
So how do you address that old adage of fail fast, learn quick?
You said it's just that extent you have to iterate on everything quickly, and you also have to. We obviously don't set out to fail. I mean, okay, I mentioned that we sometimes spend money on testing high-risk groups in order to collect data. That would be the FAFO type experiment, which we do. But you obviously don't do that on the compliance side, and you don't do that on the product side. So yeah, if you operate at a high velocity, you operate at a high level of quality, and when you do fail, you fix that fast. I think it's part of the culture that compliance is also part of that high velocity, it's not back in my bank days, group risk management we referred to as the Department of No, and that's not necessary, and it's not part of our culture, and therefore it's part of what keeps it running. It's just another. I would say compliance is not the biggest challenge that we have to deal with, and therefore it's not an excuse for moving more slowly, given the other things we're overcoming.
Okay. Yeah, maybe I can actually pick up on that. I think from our perspective, we really view compliance as kind of it's the foundation, and as a result, it should be built in as part of the product design. Because the moment you strip compliance away from the product design, that's where you run into the problems and the friction, and then compliance becomes the problem, the gatekeeper, because it's just not been built correctly up front. I think the other kind of key thing that I'd want to point out is it's not just saying no, it's how do you get to yes in a way that then is also scalable. Because if we're just saying yes to launch one-offs, then we're probably not making and having the impact that we want to have in the market.
Yeah, I guess I'll say, I think the framing, and you were kind of touching on this, Richard, of like compliance versus innovation is completely incorrect framing. Like, it's partly building it into product design. It's also like thinking in a first principles basis about like, why does the compliance or regulatory regime that you're trying to fit into exist? And often like in financial services, there's so many examples today where we're still dealing with regulations that were written 50 or 100 years ago. So of course there's going to be a mismatch, but if you build your product construct in a way that meets the principles of what that was trying to create or what the reason for the compliance is existing in the first place was, I think oftentimes you can find abilities to create the products that you want to create and still serve them to your customers in a compliant way. And so there's so many examples like in our space where if you ask somebody who had been in the industry for a long time, they would just simply tell you you cannot build that product construct because of X, Y, and Z. So I do think you have to challenge that status quo and not just accept that as a given and say, well, actually, I think that this product construct can exist. How do we build it in a creative way that we can actually deliver it to end customers?
Yeah, I like that approach around looking for the path to yes, right? The path to good. And looking at compliance and viewing it more as a competitive advantage even, right? So that customer confidence, especially in a market challenger, and right, something that may not be as established. Okay, we're going to tie this all back to our theme of building a portfolio beyond the card itself. So the card product is often seen as a customer acquisition tool, and our goal is often the larger lending relationship. One, I'll ask, do you agree with that statement, right? And then the other is, and how effective has your card program been for your organization as the primary entry product, or are you seeing something different?
Yeah, okay, I'll start. So I'm going to focus again on prepaid cards because that is kind of the space that we operate in. And I really see that as an on-ramp, and it's kind of that strategic wedge, as we're saying here, into a deeper financial relationship. We're currently underserving people in communities who need access to need and want access to better financial products and services. So kind of a lack of competitive intensity means lagging productivity and often higher costs for end consumers. So kind of if I look at our role in this space is to build that financial stability, using kind of your building blocks to enable fintechs to innovate responsibly and fostering growth with a focus really on safety and soundness. For a sponsoring bank, every program manager we onboard represents access to a new customer base, a new customer use case. And again, if we look at markets like early wage access, you look at government disbursements, digital payments that promote financial health and inclusion for millions of Canadians. So that's really, it's more than just a prepaid card. It's how do you then take that, understand customer behavior, and link it to other solutions, and it's really providing solutions, not a single product.
Okay.
Sure. Yeah, I guess I don't agree with the statement. And specifically because
that's okay.
Yeah, I think that the reason is the framing of cards as an acquisition product makes the assumption that cards are all commoditized and they all do the same thing, which I think is true in many cases. But I'll just give you, our product construct, for example. We launched the first ever multi-currency credit card. So what that means is that you can spend money in CAD, USD, Euros, GBP, and settle those card balances in those native currencies. So if you're a finance and treasury team that manages card spend in different geographies, that is an incredibly valuable product for you. That is an innovation that leads to that product not being like a loss leader or a card product that is just like a way to acquire a customer and then hopefully I can cross-sell customers on other things. It's a card product that we can actually make economically viable because people are coming for the actual product offering we've created. They're not just coming for credit and then we have to make money some other way. So I think if you think in a more out-of-the-box way about what a credit card program can look like, I would argue that there are ways to make it not just a loss leader or a first entry point product, but a way to make it a monetization tool. So, we often have customers that will come to us to get banking services, for example. So they'll come to us to open up accounts in the United States, and then we will then say, hey, if you need, once we have their data and we can see their banking information, we can say, do you now need access to credit products so that you can spend in other geographies? So that's flipping that on its head, where instead of using the card as the acquisition tool, we're acquiring them for banking, knowing that they're a cross-border business, and then cross-selling them onto the card product.
Okay, I'm going to agree with Cato and then disagree with myself. The cards don't have to be the acquisition product. But that said, Khalifa Neo, they were the first product and they were a core part of growing the business, partly through direct customer acquisition, partly through acquiring portfolios. But It is now, our single largest product and is a major way of acquiring customers, but we acquire customers because they come to Neo to have their financial needs met. And for many of the customers in our core demographic, that's a need for credit. And the best way of meeting that at the moment is a credit card, whether secured or unsecured. And so, yes, it is a primary acquisition tool for us. That said, what we are trying to sell to customers is that full financial relationship, the support that goes with that, the education, the progression, all of those pieces. So we do have deposit accounts and checking accounts, and we do sell those directly, often as a customer acquisition product too. The value in all of them of progressing customers to being, valuable customers remains sort of the fundamental core of banking, which is, can you sell people multiple products over their lifetime, so you meet all of their needs, and across that range of products you're able to do so profitably whilst providing with good service. And the reality is, as soon as you have the customer on one product, you've started collecting data on them, which means you're better informed about offering them the other products and can therefore do so more appropriately for the customer and more successfully for your own business. So yeah, we will continue to offer cards as an acquisition product, but not by default and not necessarily always the first, because I think the reason why it gets used as an acquisition product is, again, a feature of, to some extent, of the market. I was about to say the Canadian market, it's probably true in other countries, that people's checking account relationships are really hard to peel away because it's embedded in, everyday activity, and, they have bill payments and direct deposit of salary, all of those features which mean that, checking account is hard to move. Credit card is more mobile, and therefore you're better able to peel people away with a credit card. Similarly, if you're prepared to extend credit to people that other providers aren't, there's an opportunity to capture market using a credit product, a particular credit card. So I think there are, good fundamental reasons why it can often act as an acquisition product, and therefore it does come down to, do you have the ability to then convert that relationship into something broader and deeper, which obviously we seek to do. But I think, there's nothing, those are the reasons I think why traditionally it gets used as acquisition, but, to Cato's point, it doesn't have to be. Really, the acquisition product should be the one that meets your client's needs at that moment.
Well, so absolutely. So I think what I'm hearing is it's really dependent on the segment, the customer segment, and the need of the customer. And that's really what's driving whether or not it's my credit card first, my deposit first, whatever it is that I'm looking for. But just humor me then. For those, for the segment that we are using, the credit card as your first sort of acquisition, first line into your organization. And really it is a view about that stickiness that we just talked about. So, what would you say is the single most effective, or maybe just most effective piece of data or customer behavior that you've been able to glean from their card usage, from the card program itself, and how is that feeding into the cross-sell probability, right, into the broader part of the business? Are the other lines of business using that data and then selling in?
Yeah, I can go for it. For us, it's a relatively easy one. It's where they're spending. So if they are spending, in our case, for example, with a lot of cross-border activity, we know that there's cross-monetization opportunities into international deposit accounts, into foreign exchange, et cetera. So I think that's a big one. The other one is repayment history as well, which feeds a number of different products, but also the credit product itself. If we can observe patterns of repayment, for example, if somebody's repaying their card every week versus somebody takes 2 months to pay every time, that also signals a slightly different customer and then a different account management approach. So I'd say those would be the top two for us.
Yeah, I think obviously repayment behavior is core piece of data that you collect, but then to Cato's point, the way that they use the card, for us, it can often be about obviously the distinction between transactors and revolvers, but also the extent to which they use our rewards program or the extent to which they appear not to use a rewards program. We can clearly detect those patterns of behavior, which then drives an understanding, our deposits business, which is very interested in people's likely behavior on a savings account. Are they going to? Is it hot money, or is it somebody who's going to bring it and stay? That's data that they can glean from payment behavior transaction behavior on the credit card, and people's approach to rewards programs are good indicators. So yeah, there's, as I said at the beginning, there's a bunch of data in those first few months which suddenly give you a much better understanding of the client and the opportunity to do a lot more interesting things with them.
Right. I mean, I think maybe one small final point from me. If I look at our prepaid, I don't think it's actually the first step, but it does help us connect some of the other solutions and offerings that we have. So whether it's settlement challenges being faced by our clients, whether it's subledgering needs that they have. So how do we actually create a solution, tying that together to help support kind of whatever stage the fintech is in, or the challenger bank is in, and helping them to then kind of grow their customer base ultimately.
Yeah, terrific. Guys, you know what? I can't believe it. So as the saying is, time flies when you're having fun. And we are wrapping up. So really big thank you to Cato, Richard, and Allison for their energy and their insights. I was saying this is a bit like speed dating. We covered a lot of ground in a really short time, but I think it's clear the Canadian card market's dynamic. It's driven by analytics and innovation from all sides. And please feel free to introduce yourselves to any one of us if you want to continue the conversation. But thank you for joining us.